September 15, 2008, Monday morning. Lehman Brothers, 158 years old, fourth largest investment bank in America, files for bankruptcy. $39 billion in assets. Gone. The Dow Jones plunges 504 points in a single day. By the time markets close, $700 billion in wealth has evaporated. But here's what nobody tells you about that day. It wasn't the beginning. It was the middle. We've just spent 7 videos watching empires collapse following the exact same pattern. Spain flooded with silver, printed fake coins, went bankrupt 9 times. The Dutch East India Company monopolized trade, committed genocide, collapsed anyway. JPMorgan saved America in 1907 because one man was too powerful. Rockefeller controlled 90% of oil, was broken up, ended up richer. Carnegie gave away his fortune, couldn't erase the blood. And in every single case, there was a moment where everyone said, "This time it's different. We've learned. We've evolved." It can happen to us. 2008 proved we learned nothing. This is the story of how America's financial system followed the exact same script that destroyed Spain, Britain, and the Soviet Union. How we saw every warning sign and ignored them all. And how, 17 years later, we're doing it again, faster. To understand 2008, you have to start 6 months earlier. March 14, 2008. Bear Stearns. Bear Stearns was the 5th largest investment bank in America. $400 billion in assets, and it was dying. For months, Bear Stearns had been hemorrhaging money on subprime mortgages. Bad loans packaged into complex securities and sold as safe investments. By March 13th, Bear Stearns called the Federal Reserve. "We're out of money. We can't open tomorrow." The Fed had a choice: let Bear Stearns fail or bail them out. They chose bailout. Over one weekend, the Fed orchestrated a shotgun marriage. JPMorgan Chase would buy Bear Stearns for $10 per share, down from $93 2 weeks earlier. The Fed would provide $29 billion to sweeten the deal. Bear Stearns avoided bankruptcy. Creditors were saved. The system held. And that's when the real damage was done. Because the moment the Fed rescued Bear Stearns, they sent a message to every other investment bank on Wall Street. "We will save you. You're too big to fail." Lehman Brothers heard that message. Merrill Lynch heard it. AIG heard it. And they all made the same calculation. If we're going to be bailed out anyway, why not take more risk? This is called moral hazard. When you remove the consequences of failure, people take bigger risks. Spain borrowed knowing they'd default. Britain printed knowing the empire would cover it. The Soviet Union spent knowing oil revenue would save them. And in 2008, Wall Street gambled knowing the Fed would rescue them. After the Bear Stearns rescue, Wall Street relaxed. Lehman Brothers, in particular, felt safe. They were bigger than Bear, more connected, more systemically important. If Bear got saved, Lehman definitely would. So Lehman didn't cut risk, didn't raise capital, didn't prepare for failure. Why would they? The Fed had proven it would step in. But behind closed doors, the mood was shifting. Treasury Secretary Henry Paulson was furious. He was being called Mr. Bailout. He was blamed for creating moral hazard, and he decided, no more. Summer 2008. Lehman Brothers is in trouble, mounting losses. Rumors swirling, stock price collapsing. Lehman's CEO, Dick Fuld, assumes the government will rescue them. He doesn't panic. Doesn't sell assets at a loss, doesn't seek a private buyer aggressively. He waits for the Fed. September 12th to 14th, 2008. Lehman weekend. Paulson, Bernanke, and Geithner call an emergency meeting. They tell Wall Street CEOs to save Lehman themselves. Barclays tries to buy Lehman. British regulators block it. Bank of America looks, then buys Merrill Lynch instead. By Sunday night, there are no buyers, no deals, no rescue. Paulson makes his decision: let Lehman fail. Monday, September 15th. Lehman Brothers files for Chapter 11 bankruptcy. And the market explodes. Here's why Lehman's failure was catastrophic. For 6 months, the market believed the government would rescue too big to fail institutions. Bear Stearns reinforced that belief. And then, with no warning, the government reversed course. If Lehman could fail, anyone could fail. September 15th. The Dow drops 504 points. September 16th. AIG, the largest insurance company in America, is hours from collapse. The Fed bails them out with $85 billion. September 17th, money market funds considered safer than banks start breaking the buck. Investors panic and withdraw $144 billion in a single day. September 18th, the commercial paper market freezes. Companies can't get short-term loans to make payroll. September 19th, Paulson and Bernanke go to Congress and say, "Give us $700 billion or the economy ends." Within 2 weeks of Lehman's bankruptcy, stock markets crash globally, credit markets freeze. Banks stop lending to each other. Unemployment starts rising, the Great Recession begins. Why did one bankruptcy cause this? Because uncertainty kills markets. When Bear Stearns was saved, the market knew the rules. Too big to fail meant rescue. When Lehman was allowed to fail, the rules changed instantly. And when the rules change mid-crisis, trust collapses. Creditors pulled out of every risky institution. Banks hoarded cash. Lending stopped. The same pattern that killed Spain, Britain, and the USSR was playing out in real time. Overextension, misallocated capital, sudden loss of confidence, collapse. October 3, 2008. Congress passes the Emergency Economic Stabilization Act, $700 billion in taxpayer money to bail out the banks. The Troubled Asset Relief Program, TARP. Banks that had gambled recklessly, that had created toxic securities, that had caused the crisis, were now being rescued with public money. And this is the moment that proves we learned nothing, because this is exactly what Spain did. Spain borrowed from foreign banks 9 times, defaulted, restructured, borrowed again. The pattern: take on debt gives crisis, gives bailout, gives repeat. Britain did the same thing. Borrowed during World War I, couldn't pay. Borrowed during World War II, still couldn't pay. Empire collapsed under debt. The Soviet Union did it too, spent beyond capacity. Oil money covered it, until oil prices dropped, then collapse. And in 2008, America followed the script perfectly. Private banks took insane risks, made billions in profits. Then when the bets failed, the government bailed them out. Privatized profits, socialized losses. By 2010, TARP had distributed $245 billion to banks, $80 billion to the auto industry, $70 billion to AIG. Most of it was eventually repaid. But that's not the point. The point is, we didn't fix the problem. We rewarded it. Banks that were too big to fail in 2008? They're bigger now. JPMorgan Chase in 2008, $2.3 trillion in assets. JPMorgan Chase today, $3.9 trillion. We broke up Standard Oil in 1911 because monopolies are dangerous. In 2008, we made the monopolies bigger and called it stability. Here's what caused 2008. It wasn't subprime mortgages. It wasn't greedy bankers. It wasn't deregulation. Those were symptoms. The cause was cheap money. In 2001, after the dot-com bubble burst, the Federal Reserve dropped interest rates to 1%. Kept them there for years. When money is cheap, people borrow. Banks lend. Asset prices rise. Housing prices doubled between 2000 and 2006. Why? Because money was free. Anyone could get a mortgage. No income? No problem. No down payment? Approved. Banks weren't stupid. They knew the loans were garbage. But they didn't hold the risk. They packaged the mortgages into securities and sold them to investors. And because interest rates were so low, investors were desperate for any return. They bought the toxic securities without looking inside. This is the same mistake Spain made. Spain had unlimited silver, so they stopped producing, stopped innovating, just spent. When the silver ran out, the economy collapsed. America had unlimited credit, so we stopped producing, stopped saving, just spent. When the credit ran out in 2008, the economy collapsed. The pattern doesn't change. Easy money destroys productive capacity. And when the easy money ends, everything built on it crumbles. So what did we learn from 2008? Nothing. After the crisis, the Federal Reserve dropped interest rates to 0. Kept them there for 7 years. Then COVID hit. They printed $6 trillion in 2 years. Today, the national debt is $36 trillion. Up from $10 trillion in 2008, we're spending $1 trillion per year just on interest. Banks are bigger. Debt is higher. The system is more fragile. And we're pretending it's fine. In 2008, we said, this will never happen again. In 2023, Silicon Valley Bank failed. Then Signature Bank, then First Republic. 3 major banks collapsed in 2 months. The Fed stepped in, guaranteed all deposits. More bailouts. We're in a loop. Crisis gives bailout, gives more risk, gives bigger crisis, gives bigger bailout. Spain ran this loop for 150 years. Each bankruptcy worse than the last. We're on our second lap. 2008 was crisis 1. The next one will be bigger, because we didn't fix the foundation. We just papered over the cracks. 3 empires collapsed following a pattern: overextension, currency debasement, debt spiral, loss of production, social decay. Then collapse. In 2008, we hit stage 5. And instead of reversing course, we accelerated. More debt, more printing, more bailouts, more risk. 17 years later, we're deeper in the pattern. The script is written, we're just reading it faster. JPMorgan saved America in 1907 when one man was too powerful. So we created the Federal Reserve to prevent that. Now the Federal Reserve is too powerful. It decides who fails and who doesn't. Rockefeller was broken up because monopoly is dangerous. Now our banks are bigger monopolies, and we call it systemic importance. Carnegie gave away his fortune, couldn't buy redemption. Now billionaires get richer during crises while the middle class disappears. We've learned nothing. Because we refuse to learn. Every generation thinks, this time is different. We're smarter, we have better tools. And every generation learns the same lesson the hard way. You can't print your way to prosperity. You can't bail out bad decisions forever. And you can't break the laws of economics just because it's inconvenient. The pattern says the next crisis will be worse. The debt is higher. The money is cheaper. The system is more fragile. And when it breaks, it'll break fast. Maybe we'll wake up. Maybe we'll fix it. But 2008 was the warning, and we didn't listen. If this opened your eyes, subscribe. Because when the next crisis hits, you'll want to understand what happened. The answers aren't hiding. They're in the pattern, and I'll show you where to look. Drop one word if this hit you: pattern. See you on the other side.